Lithium's status as a darling of the energy transition narrative is under increasing scrutiny. Prices have plunged from their COVID-era highs. The market is awash in new supply, and geopolitical trade barriers are reshaping the competitive landscape. Four-Strong Asset Management's lead portfolio manager, David Kletz, notes these shifts signal both danger and opportunity for investors who may be eyeing lithium's long-term potential. Kletz sees lithium as a compelling long-term investment theme, tightly linked to sweeping global shifts, such as electrification, grid modernization, and the rise of electric vehicles. But he also sees the lithium market as being caught between long-term optimism and short-term pain. After a dramatic run-up during the early 2020s, prices have since collapsed, erasing nearly all the post-COVID gains. They had a boom period, and they've since basically given up all of that, he said. In terms of momentum, the acute phase of that sell-off is seemingly behind us. Charts can change direction at a pin drop, but the trend is still lower. Additionally, China's entry into the market with lower cost production techniques has disrupted traditional supply dynamics, as Chinese producers can manufacture lithium carbonate from US $8,000, $10,000 per ton, far below the $12,000, $15,000 range faced by Australian spodumene operations. This cost edge has allowed Chinese firms to flood the market while remaining profitable, putting significant pressure on competitors. Undoubtedly, Western manufacturers are watching what the Chinese are doing, and they're going to attempt to reverse engineer the success that those Chinese battery makers have had in making superior battery stacks. Added Kletz, it's not something that gets switched overnight, but when that happens, you'll see another wave of heightened interest in electric vehicles in the West. Demand for electric vehicles has fallen short of expectations. Although EV sales are still increasing, growth has slowed markedly, from 35% in 2023 to just 18% 2024. Economic uncertainty, notably around the ongoing trade war, uncertain political electrification policies, and growing consumer interest in more budget-friendly hybrid models, are major factors behind the deceleration, explained Kletz.